Welcome back to Gold Rush Reporter, your trusted source for real, no-nonsense insights into the gold and silver markets. I'm your analyst, breaking down what's really happening behind the metal moves, because this isn't just stacking anymore. This is strategy. Let's start with a question. When does collecting gold stop being a hobby and start becoming a serious financial commitment? That line gets blurred fast when a single ounce of gold costs over $4,000. Think about it. Every percentage point in the price of gold now represents about $40 per ounce. That's not a minor fluctuation anymore. It's a decision that can match your monthly mortgage payment. We've all had that moment where we made an impulsive gold purchase. Maybe a coin we liked, maybe a series we were trying to complete. Back when gold was $1,700, it felt harmless. You bought the coin because you loved the design. It was passion, not strategy. But at $4,000 per ounce, it's different. Every decision now demands justification, not just desire. For many collectors, this rally has been both thrilling and suffocating. The excitement of seeing your portfolio grow is being offset by the pressure of keeping up. The Perth Mint's Lunar Series is a perfect example. The 2023 Rabbit coin cost $1,700. Then came the 2024 Dragon at $2,150, the 2025 Snake at $2,900, and now the 2026 Horse, an incredible $3,900. Same series, same ounce, but the price has more than doubled in just a few years. Sure, that's a dream scenario if you already hold earlier coins. But for anyone trying to keep up with the series, it's become nearly impossible. What was once an affordable passion project is now a serious financial decision, one that demands planning, not impulse. And it's not just collectors feeling the squeeze. Even dealers are adapting. Check out the US Mint's American Liberty High Relief release. A stunning coin, yes, but with a 25% premium, the final price was nearly $5,000. That's why I passed on it. A few years ago, I might have grabbed it without a second thought. But these aren't the same times. When gold doubles in 2 years, the stakes double with it. The margin for error disappears. The hobbyist mindset doesn't cut it anymore. We're in investor territory now. This rally is rewarding those who plan and punishing those who don't. As gold prices continue their climb, something deeper is shifting beneath the surface. The psychology of stacking itself. The same collectors who once bought with excitement are now buying with hesitation. It's not about passion anymore. It's about risk management. Every purchase now comes with a mental calculation. Not, do I want this? But can I justify this? Let's talk about premiums. The hidden cost that's quietly killing enthusiasm in the gold market. When gold was around $1,500 to $2,000, paying a 5 to 10% premium felt manageable. It was the price of beauty, of craftsmanship, of having something tangible. But now, some gold coins are pushing 20 to 30% premiums, and that's forcing even experienced stackers to hit pause. Here's the cold reality. The higher the spot price, the less room premiums leave for profit or flexibility. A 20% premium at $2,000 means $400 over spot. But that same 20% at $4,000 means you're paying an extra $800. That's not a rounding error. That's the difference between a smart hedge and a financial strain. We're seeing this play out everywhere, from limited Perth Mint coins to high-relief US Mint releases. The collectors who once prided themselves on completing every series are now skipping years or switching to smaller weights. It's not about losing interest. It's about adapting to a new reality. And this is where fractional gold is starting to take the spotlight again. 1/10 or 1/4 ounce coins, which used to be dismissed as overpriced or inconvenient, are now becoming the gateway for those who still want exposure without the financial hit. Sure, they carry higher premiums percentage-wise, but psychologically, they're more manageable. Spending $500 feels safer than $4,000, even if you're paying a little extra per gram. Another trend that's quietly growing is the secondary market. Collectors selling older pieces not because they need cash, but because they want to rebalance their portfolios. When gold was cheaper, nobody sold their coins. They just kept stacking. Now, with record highs, people are offloading duplicates, older series, and collectibles that no longer fit their strategy. It's not panic, it's recalibration. But here's the kicker. Even in this shifting market, demand hasn't collapsed. If anything, it's evolving. The audience is smarter, more disciplined, and less impulsive. Buyers are reading balance sheets, tracking mint releases, and thinking like investors, not hobbyists. That's why despite the price climb, mints are still selling out of major releases in minutes. We're witnessing a transformation. Gold stacking is becoming professionalized. The emotional impulse is being replaced by strategic awareness. And in this new environment, knowledge is the real asset. Because, make no mistake, the next phase of this bull run won't be won by the loudest buyers, but by the smartest planners. As we move deeper into this gold bull run, the dynamics between collectors, dealers, and mints are evolving fast, and not always in ways that favor the average buyer. Behind the excitement of rising gold prices, there's a quiet reshuffling happening in how supply, pricing, and allocation work in the precious metals market. Dealers, once happy to sit on inventory, are now operating in survival mode. With gold over $4,000 an ounce, the cost to restock has become a serious financial burden. Think about it. When a dealer orders a batch of 1,000 ounces, that's over $4 million tied up in metal alone. Add premiums, insurance, and shipping, and you're looking at multi-million-dollar exposure. That kind of capital lockup simply wasn't a concern a few years ago when gold was half the price. What that's causing is a tightening of supply at the retail level. Dealers are ordering less, keeping margins higher, and prioritizing their most loyal or high-volume clients. The casual buyer, the one who walks in looking for a single coin or bar, is no longer their main focus. The game has moved upmarket. Even the mints are changing strategy. Limited editions used to mean genuine scarcity, 10,000 pieces worldwide, maybe 25,000 if demand was strong. But now we're seeing a different approach. Mints are stretching out production, releasing more exclusive variants, and quietly adjusting mintages mid-series. It's smart business. When demand is strong, they milk it. But for collectors, it's creating fatigue. When everything is labeled limited, nothing really is. And this fatigue has consequences. The overproduction of special issues means buyers are becoming selective again. Instead of buying every new release, they're researching which ones have real long-term value, lower mintages, historic themes, or unique design significance. That's where the serious investors are focusing their money. Meanwhile, on the wholesale side, central banks and large-scale institutions are absorbing a massive portion of global gold output. They're not flipping coins or chasing collectibles. They're buying tons of metal at a time, moving it off the open market and into reserves. This silent accumulation creates a secondary squeeze. The physical gold that would normally end up with retail dealers just isn't making it there anymore. This shift in flow is part of why premiums stay stubbornly high, even when spot prices fluctuate. There's less physical supply reaching the retail level, and every ounce is fought over. The irony? Many collectors still think dealers are price gouging, when in reality, most of them are just trying to survive shrinking margins and rising costs. Another underappreciated effect is delivery time. Even major bullion dealers who used to ship next day are now quoting 2 to 3 week delays for certain coins. That's not because they're lazy, it's because the logistics system is backed up. Mints are working at capacity, refiners are overloaded, and transportation costs are higher than ever. What we're seeing now is a maturity phase in the gold market. The easy days of cheap, readily available bullion are over. This is a market that rewards patience, knowledge, and timing. Here's where things start to get serious. The rally we're in isn't just another cyclical upswing. This is the kind of structural shift that redefines how gold functions in the global economy. When prices double in under 2 years and premiums hold steady even at record highs, you're no longer dealing with simple supply and demand fluctuations. You're dealing with a monetary realignment, and that's exactly what's happening. Let's start with the hard truth. Most retail investors are still thinking small, while the major players are thinking generational. Central banks are hoarding physical gold at a pace unseen in 55 years. They're diversifying away from the US dollar, hedging against fiscal instability, and preparing for what many believe will be the next monetary framework, one where tangible assets back digital value. Meanwhile, governments and institutions are locking in supply, not because they want to sell gold, but because they want control over collateral in an increasingly leveraged global system. Once gold crosses a psychological threshold, say $5,000, it won't just be a commodity anymore. It'll become a reference asset, the anchor behind new digital settlement systems and reserve mechanisms. Now, if you're a private investor or collector, here's the brutal truth. You're playing a different game. You don't have access to bulk contracts or institutional pricing. You operate in a retail market built on premiums, timing, and scarcity. That's why the smartest move now isn't to chase every coin that hits the market. It's to consolidate. Focus on liquidity, recognizability, and fundamentals. That means high-demand coins like American Eagles, Maples, Buffaloes, and Britannias. Leave the overhyped, artistic releases to the hype crowd. Because here's the catch. When the system shifts, exit liquidity matters. You want gold that you can sell instantly at the tightest spreads, no questions asked. That's what real stackers are doing now. At the same time, silver is becoming the undervalued hedge in this scenario. Historically, when gold starts stabilizing after a massive rally, silver plays catch-up, fast. It's volatile, yes, but the upside percentage moves are brutal in a good way. The gold-to-silver ratio has been flirting around 80-1, a historical extreme that usually signals silver is grossly undervalued. If gold continues upward pressure, silver's response will be explosive. But don't mistake excitement for strategy. This market demands discipline. Emotional stacking, buying every dip or panic selling on corrections, will destroy your long-term position. This isn't the time to speculate. It's the time to build a resilient foundation. And one more thing. Stop waiting for the perfect entry point. You're not going to catch the bottom again. The era of $1,700 gold is gone, probably forever. Waiting for it to come back is like waiting for Bitcoin to drop to $5,000. Delusional. The new floor is higher, the liquidity base is deeper, and the participants are larger. That's how you know the market has matured. So the best move right now? Accumulate intelligently. Stay consistent, ignore hype, and position yourself for what's next. A financial environment where gold and silver aren't just stores of value, but active instruments in a digitized, collateral-driven economy. Let's bring it all home. What we're witnessing right now isn't a typical bull market. It's a global shift in how people view wealth, trust, and value. When gold crosses $4,000 and keeps climbing, that's not just traders pushing prices. That's entire financial systems adjusting. The same metal that used to be seen as a hedge is slowly becoming the core collateral for the new monetary world that's forming right in front of us. For everyday stackers, that means the game has changed. You can't afford to treat gold or silver like side hobbies anymore. These metals are now part of a serious strategic portfolio. The margin for error is thinner, the stakes are higher, and the opportunities are greater. But that also means discipline and knowledge are everything. The people who survive this cycle won't be the ones who chase hype. They'll be the ones who stay consistent, buy smart, and think long-term. Silver, on the other hand, is still the sleeper. When this gold momentum eventually cools, silver will wake up, and it will move with speed. History repeats itself here. Every time gold breaks records, silver follows with aggressive catch-up rallies. The ratio is screaming imbalance, and if it corrects even halfway, we could be looking at silver doubling faster than most expect. So here's the honest truth. We're entering the stage where emotion, greed, and panic will cloud judgment. Ignore it. Let others gamble. You focus on strategy. Whether you're buying full ounces, fractionals, or diversifying with both gold and silver, do it with purpose. Don't overextend. Don't chase trends. Stack smart, not fast. And one last point. The people who'll benefit most from this rally are the ones who actually understand what they own. Don't just stack for the sake of stacking. Learn the history behind your coins, know your exit plans, and keep your records clean. Because when this system transitions, and make no mistake, it's already happening, those who hold real, verifiable assets will be in a position of power, not panic. That's all for today's breakdown. I hope this gave you a clearer view of where we are in this gold and silver cycle, and more importantly, where we might be heading next. If you found this analysis useful, make sure you like this video, subscribe to the channel, and turn on notifications so you don't miss what's coming next. We've got deeper dives lined up, including what central banks are quietly preparing for 2026, and how silver could outperform expectations once institutional liquidity shifts. This is Gold Rush Reporter, and I'm your gold and silver analyst, signing off for now. Stay smart, stay steady, and keep stacking with purpose.